Welcome to Richard Suttmeyer's 4 and 4. 4 blips on my radar screen presented in 4 minutes or less. The overnight news has not been good for the open on Wall Street. The dollar continues to weaken. Australia raised interest rates 25 basis points to 6.75. Crude oil traded above $98 per barrel as that parabolic rise continues. Geopolitical tensions heighten on new bombings in Afghanistan and on an attack on an oil pipeline in Yemen. Oil supply concerns and the weak dollar have already fueled speculation that oil could top $100, and inventories are expected to be lower again when reported this morning at 10:30 a.m. Gasoline at the pump is now above $3 per gallon on Main Street across the USA. Gold continued its parabolic rise and traded as high as $8.48 the ounce this morning. Today I discuss how these new highs and new lows will affect the U.S. capital markets. My first blip is the new 52-week low for yield on the U.S. Treasury 10-year note, set at 4.276 on Monday. The bond conundrum just won't end, and the U.S. Treasury auctions 13 billion new 10-year notes today. If this yield is trading north of my daily pivot at 4.383 at the time of the auction at 1 p.m., the underwriting could become problematic. Yields are lower than they should be at this time on the flight to quality relative to the ongoing credit crunch, but with a weak dollar, the indirect bids from Asian central banks could be sparse. My second blip is the new 3-decade high for COMEX gold at $8.48 the ounce overnight. I talked about a potential parabolic rise given a trend above my quarterly pivot at 813.1, and without another longer-term resistance, there is no telling how high gold can trade as the currency of last resort. My third blip is the new all-time high for NYMEX crude oil at 98.62 per barrel overnight. Strength relates to supply concerns, the weak dollar, and heightened geopolitical risks that appear to be spreading around the world. My fourth blip is the new all-time high for the euro at 1.4704 versus the dollar. We know that one reason for the weak dollar is the fact that the Federal Reserve cut the federal funds rate by 75 basis points to 4.5% since September 18th. This puts upward pressure on gold and crude oil, and the credit crunch keeps yields too low given renewed inflationary pressures. My fearless prediction for the week, presented in the Right Side Free Weekly and called Richard Suttmeyer's Weekly Radar Screen, was that the dollar versus Japanese yen would fall below its 200-week simple moving average at 113.17, and that such a trend would cause additional risk aversion and further unwinding of what's called the yen carry trade. The weekly chart shows this potential. Obviously, the highs and lows I presented here are not positive for U.S. equities, and the problem began with my market call, beware of the Ides of October. That's when the wave of quarterly results from community and regional banks began and showed reduced net income, increased loan loss provisions, and when the word write-down came into vogue. You cannot have a bull market for stocks with a bear market for our nation's bank. I will continue discussing market conditions on Traders Club Thursday evening at 6 p.m. on Right Side Live. Please send your comments, questions, and stock symbols to support@rightsideadvisors.com so I can complete my homework for our live chat and internet radio show. That's today's 4 and 4. Enjoy your day.